Now we get to turn to my favorite topic, which is inflation. And to nobody's surprise, we have failed to reach a top again because everyone, and the running joke is that if you continue to say that this is the peak inflation, eventually you'll be right. But we continue to see a lot of upward pressure on, as we said in June, we expected June numbers to be very elevated based on crude pricing, gasoline prices, diesel, everything was going parabolic in June. That has pulled back. So right now we do see July being below June. We still see expansion. We still see inflation going up, but again, not at the level that it went up. And the reason why we continue to see it going up is because of the broad-based price increases. And we really want to talk about them as we go through what they are, what are their drivers, and why that's so important. Now, the Fed Beige Book, the outlook for the future GDP growth is mostly negative. Contacts in 5 districts noted recession concerns. Many districts said supply chains hamper output. So again, you're still seeing a lot of these pressure points all the way through. But one of the things that we've been talking about is flexible inflation versus sticky inflation. So when you look at this line here, the yellow line is sticky. The other line is flexible. And when you go back through time to the 1960s, you get an idea, and it was 1970s, that flexible is at astronomical levels and very much on par with where they were back at the 70s. But sticky isn't there yet. And really because it takes time for that to filter down. And as the broad-based increases continue, it's filtering down to that sticky component on inflation. And that's what is concerning the Fed the most. Obviously, there's bond volatility. There's the elevated level of dollar value, but there's also this sticky nature. And these are things that aren't going to pull back. We still have a lot of upward momentum in shelter of the CPI calc, of other, everything core-based, X energy and whatnot, which is why sticky, even as flexible comes back, like when we look at what is going to be the driver in July so far through July 14th, diesel and gasoline is going to be a negative driver of inflation, or deflationary, if you will, which will show up in the flexible number, while the sticky number is going to continue to see its upward trajectory. And here's why. So when we look at including top line, the services, X food and energy continue to go up. So look at how that yellow bar continues to shift higher, even as other things start to cool off. Obviously, there's energy. But when you look at goods, X food and energy, inflation's going up. Prices are going up. So you continue to see this upward momentum. Yes, that energy bar, that pink bar, will flip to the downside in July. As of right now, obviously things based on the volatility in oil, it could easily reverse. But we think that oil and crude in general is going to be fairly range bound, which is going to pull down some of that. But it doesn't reverse the food, the goods, the services. Those pieces are going to continue to be there. So when you look at the top 5 components, you have the remaining contribution. So that orange number, the orange catch-all, continues to go up and continues to expand. So yes, that gasoline of all types, that will contract. But rent or shelter, still a big contributor, and it's moving up. When you look at utility piped gas services, that's going up again. So even as you have gasoline, oil, and diesel coming down, natural gas is going up. You continue to see that moving in the upward momentum. So even as you have some energy components, and obviously big ones for that calculation, the electricity side, the natural gas side, that is, again, providing some of that tailwind while you get some of those headwinds, keeping things very elevated in general. So when you look back to the sticky price and why we talk about that, so obviously when we zoom out further, you get an idea of where flexible is, and look at where it is in relation to the 70s. Flexible is at a 20% increase versus the peaks that were in 1975 and in 1980. which was about 14% and about 17% and 18%. So we're sitting at an area that is above, but look at core. It's still starting to get its momentum. It's still starting to get its way through, and that flexible still is pricing its way down. And some of that flexible spend pricing goes into the sticky side, and it doesn't go away quickly. We have, I think it was in rents in in New York City are back to about $5,000. There's a lot of this momentum that is going to come into the sticky front and keep us pegged to the highs. And another leading indicator or indicator that core piece is going up is the FRB Cleveland 16% trimmed mean CPI, which is at 6.9%. So we have core CPI coming in at 5.9, but you have the trimmed mean at 6.9. So typically that trimmed mean is indicative of which direction that core is going. So even as you have that energy and the other pieces starting to roll over, there is that upward momentum. So then when you look at the San Francisco cyclical core PCE at 6.3%, that core PCE, that core piece is just showing where the trajectory is, where that is going. So with the Fed sticky CPI at 5.6, core CPI at 5.9, trimmed mean at 6.9, core PCE at 6.3, you get an idea that we still have upward momentum left. So even as the headline number will likely be better in July, there's a lot of pain to the underlying consumer and industrial sector based on some of these important indicators. And so when coming all the way back to OER, or that the owner equivalent rent, the inflation in terms of where those drivers remain, and that small cities, large cities, you're getting broad-based increases, and we don't see that changing, because as we described, I think it was 3 or 4 weeks ago, the calculation, it will never go to where we are in terms of, housing prices are up 17, 19%. You have rent up 22%, and you have OER at 5.5%. So there's still a lot of upward momentum, and likely OER will get to double digits, and that's going to be some of that backdrop. But then when you look at the 3-month change in U.S. break-evens, you get an idea that this is showing you that inflation is viewed to be still temporary. And the reason why is, as recession fears increase, the view is as recession happens, inflation will come down. But when you look at the 70s, you did have inflation come down, but it didn't go away, and you still had a recession. You still had shortfalls. You still had price controls creating issues. You still had embargoes. So you're still going to have these pressures, which is why we don't see inflation really abating in a meaningful way. We do think we get a period of deflation, but then quick inflation back up. And again, that's why we said that this decade is going to be a weird amalgamation of the 30s and 70s. But as we go through it, we're going to talk about what is going to be the driver of deflation, which we see hitting in Q1 of 23 and Q2 of 23, but then more of that inflationary pressure. But even as you get deflation, there can be an inflationary backdrop in other parts of what people spend money on, and that's, again, housing, food. So you can get some deflation on other things and inflation in other places, which is why even as things cool, you're still going to get some of this stagflationary backdrop on some of these different pieces. So coming back again to the owner's equivalent rent, you can see that at 5.5%. That is the highest since September of 1990, with a lot of upward momentum still behind it. So then when we start looking at a difficult development for the Fed in general, headline CPI inflation is outpacing core by the widest margin since 1974. So as this is just showing you what we were describing of that upward movement, how we're still not seeing the top. We still have a lot of these tailwinds that are going to drive inflation. It's just the rate of change is going to slow, we're not going to get deflation, so we still will get inflation, just not at the levels that we've seen in June. So the other key piece is the average of utility cost, gasoline, food at home, and electricity. So obviously gasoline is coming down, but utility costs not going down. Food at home not going down. Electricity not going down. So the consumer stress to the max. Among staple areas for consumers, inflation is soaring at the fastest rate in history at over 30% year on year. So when you look at the things, again, that sticky piece that isn't going away, especially on the food and electricity side, this is where people are getting hit, which is why our private equity fund is buying baseload electricity. Electricity prices are going to remain elevated for a very long time. We have mismanaged the grid for 40 plus years. We're taking down baseload capacity, we're bringing on intermittent capacity, and we're increasing the demand pull on the grid. So you're getting less stability, higher volatility, higher prices, which is why electricity is something that we think is going to stay back to the sticky component and the pressure that's going to remain on the consumer. So then when you look at just where we are in general, obviously inflation came in at 9.1%, estimate was for 8.8%, core was expected at 5.7, came in at 5.9. So again, you're seeing just where we are in that overall chain, but what does it mean for the consumer? Well, real wages tanked at negative 3.6 on an annual rate. So when you look at real spending, it continues to move lower, and we're now below where we were in 2021, and this is the lowest we've been going back, and again on this chart is to 2007. So you're getting an idea of the pain that continues for the consumer, because not only are their prices going up, you're losing real spending, you're losing discretionary capital because you're just not being able to cover the increased cost. And now to zoom in a bit, just in terms of from 2020, the hourly wages are down negative 3.6, but weekly earnings are down negative 4.4%. And you get an idea on the trend that's going down, and we continue to see more downward momentum, especially because wage growth is starting to slow a bit. And as wage growth slows and inflation continues up, this will put even more downward momentum here. And this is just looking at so far. So barring a significant move higher, the recent rolling over in energy commodities mean a hit, some of the CPI calculations will come down, but it's still positive. So, and that's the key component, is it's still going to be a positive contribution, just less, or the rate of change will be slower. So you're still going to get this pressure in July. And as we've been saying, it's that the rate of change will slow, not inflation itself. And so when I should say not deflation, but again, just the rate of change of inflation. And here's another leading indicator. June PPI came in at 11.3% year over year. The estimate was for 10.7, and last month was 10.9%. So you're actually getting a reacceleration in PPI in June. Core PPI was expected at 8.2, came in at 8.2. So when you look at month over month, it came in at 1.1% versus the estimate of 0.8. So you're seeing a lot of this pressure, and this gets passed through. Companies will try to pass through as much as possible. But one of the things that we have been saying, and for those that have been following us when we go through the different regional Fed data, what does it mean? We don't think PPI breaks to new highs. It just stays in this tight band and just increases. And again, it creates these problems that the companies will try to pass through, but also supports more stagflation and more pressure in general on the stagnating side. So then when you look at the convergence, one of the things that we've been saying is that commodities and services will meet somewhere in the center, and that continues to be the case. So like rents are becoming stickier as disinflationary forces build for stay-at-home categories, you're getting these pieces where you're going to keep getting the services moving up, some of those goods coming down, and you're going to have that convergence, obviously at a much higher level, something reminiscent to the 80s in terms of where it settles out, but you're getting an idea that you're going to get this elevated piece. So the commodities will come down, but start to flatline because obviously they went through the roof, and then services is going to continue to be on the elevated front. And one of the things that continues to be a problem is the worst in the shutdown. So when you look at the latest Chicago Fed survey of business conditions, you have the outlook for economic growth in the next 6 to 12 months is worse today than it was in March of 2020. Just 17% of respondents expect an increase in economic activity over the next year. So again, that continues to be this overhang, because if you're a company expecting things to get much worse, are you hiring? Are you investing in CapEx? Are you expanding your industrial footprint? Are you looking to sell? No, you're going to go into defense mode, and this is going to become a much bigger overhang, which is why when you look at high yield, goes from bad to worse. So when you look at high yield bonds in normal times is the second pillar of leveraged finance. These aren't normal times, obviously, so the issuance in the riskier segments collapsed to its lowest in 2Q because people or companies don't want to pay those interest rates. So that's where you see some of these companies saying, look, I'm just going to cut CapEx, I'm going to cut spending, and I'm just going to pull these bond offerings because I just can't afford this interest. And that's going to continue as we have the Fed funds futures curve continuing to shift higher. So what is the terminal Fed funds rate? Depends on obviously when and who you ask, but the expectation is for rates to peak somewhere between 3 to 3.75%, which is down from 4% in mid-June. But one of the things that we've been saying is we expect those rates to stay higher longer. So here you can see that they're pricing in a rate cut as early as 2023, and I just don't see that given some of the inflationary backdrops right now. Now, if some of the deflation things that we're starting to see creep up show up in Q1 and Q2, that does offer an opportunity to come in and cut rates. The problem that the Fed is facing, if you look back to the 70s, the last time we started to get deflation, they thought they could increase rates, and that just sent things parabolic again. Because there's so much liquidity, because if you compare to the 70s to today, what's different today? Well, obviously the stock market is gangbusters in comparison to the 70s. Home prices, rates, or even at an increasing rate perspective, we're still just over 1%. And when you look at it, we've put almost $30 trillion into circulation. So we're in a very different position. So given you have to treat things differently, but I think that's where we're going to continue to see this pressure. So market pricing for the Fed funds in July, it's pulled back a bit. The assumption is closer now. There's a 91% view that we're going to have a 1% increase. And then when you look at September, there's pretty much a guarantee of a 75 basis point hike just based on what the data is showing. But when you look at that rate of change, break-even rates descending quickly over the past 3 months, the drop in 1 year, 5 year, 10 year, steepest since the summer of 2020. We just think that starts to reverse higher and put some of that upward momentum back into the market. So then when you look at, well, what is causing this? Well, the annual growth in M2 money supply has come down to 6.5%, which is the lowest since October of 2019 and slightly below long-term average, because it has to stay below average. Because if you think about what they're trying to do, they're trying to pull liquidity out of the market. So you have to see M2 go negative in terms of issuance to get a system where you're pulling some of this capacity out. So as you pull that out, you're also increasing some of the volatility, and that's when we come back to the MOVE index. So when you look at that MOVE index, and I apologize for using the same charts, but I just want to show where things are going. When you look at when they spiked the amount of printing, that brought down bond volatility in 2020. The problem now is that isn't a tool that is available at the moment, which is keeping that bond volatility bid. So they're losing some of these metrics and some of these abilities to bring that back down. And again, keeping that pressure well in place going into the end of the year. So here's where you have the 2-year and the 10-year coming negative, and obviously that M2 3-month over 3-month, we're going to have to be below zero. We're going to have to be at that negative side as they continue to try to pull as much of this additional liquidity out of the market. And this is where we continue to sit on the yield, on the inversion. A high CPI reading, which came in, is likely to reinforce expectations for more rate hikes, while long-term prospects for the economy weaken, which again you can see is keeping us pinned at these levels. But when you look at the federal deficit, the federal budget deficit in June was just 4.3% of GDP, a figure we haven't seen since mid-2019. But we put so much money, fiscal money, into the market that you have to pull some of it out. And when you look at where it is, going back to normal isn't pulling anything out. We still need, and again, this comes back to when do you start issuing austerity and start cutting subsidies? And this is the point where, there was a huge issuance of fiscal stimulus. There, you created the fiscal drag, but now can you really go into an austerity situation, given the pressure that we're seeing and the problems that we're seeing all around us when we're looking at the global economy? And the answer is no, which then leads to the issue of, you could do it, but it's going to increase the pain, increase the slowdown, which maybe is a good thing in terms of purging the system. But again, these are the back and forth that we're looking at from also the fiscal side as well as the monetary front. But then when you take this, the misery index is moving higher. For now, solely driven by inflation, as unemployment rates will continue to remain unchanged. But inflation is increasing the pain, increasing the fear. But as we've been saying, unemployment and employment in general is a lagging indicator, and we do expect that to continue to worsen. To start to worsen, I should say, because one of the most important shifts over the couple of years, the fiscal deficit as a percentage of GDP in blue, which is inverted on the chart, and monetary policy, M2, year-over-year growth, have turned restrictive in fairly quickly in regards to the chart, which it needs to deliver that shock, because we're still above where we need to be. We're still above these levels, and we've been putting so much in for so long. You need to see some of this come out. But as you can see, typically during recessions, you get those spikes. But because we waited so long to pull stuff out, that's going to create an overhang and an inability to really stimulate in a meaningful way because of law of diminishing returns. This oversaturation. The RRP still has over $2 trillion in it. So you're still needing some of this normalcy, if you will, which is why they're in a very tough spot as we come into a questionable economic growth period. And consolidated equity positioning, people continue to consolidate their positions. Sentiment has gotten a bit worse, and that has caused people to pull some of this capacity out of the market. And then when you look at, bankruptcies are starting to pile up. As you don't have PPP loans, you don't have government sponsoring, you don't have all of these things. So you're starting to see some filings increase. So total of 13 filings was the highest since March of 2021. And we expect this to continue to move higher, all the while trucking demand, and just an indicator for growth on the underlying economy, continues to get a bit worse. And as we said in the EIA show, this is going to be one of those headwinds for diesel demand, especially in the U.S. Now, when we turn to small business, it's not surprising given what we've been talking about. Small business optimum index in blue fell in June to 89.5. The estimate was for 92.5. So lowest since January of 2013. The outlook, which is orange, continues to plunge further into negative territory and is at its all-time low. So again, if you expect your business to be in a worse position 3, 6, 12 months out, you're not hiring. You'll likely let some people go to tighten up, save some capital, save some CapEx. And again, this is the concern that we continue to have, because the small business is the largest hirer or job growth engine in the United States. And this is an indicative of where that is going and the pressure that's going to come through. So it's not surprising to see capital expenditures coming down, but jobs hard to fill remain elevated. So even though all of these expenditure plans are coming down, concerns are there, jobs are still hard to fill. So you still have to pay up in wages. Now, we do think this comes down, but just look at where it is in relation to history. Even if it comes down, you're not coming down as much as normal, because as we talked about last week, the participation rate still hasn't caught up to where we were in 2019. And it's unlikely to, given the amount of retirements, given the amount of people that at one point had 2-income households, and now they can't afford that second person to go to work because of food, childcare, inflation, just household expenses. That is prohibitive of those people going back to work, keeping people in the workforce. But even that person in the workforce is seeing their real wages go down. So even they're earning less, putting more pressure on. So again, you kind of get an idea on the cyclicality and the problems there. So not a ton of movement in general, but when you look at compensation plans, remaining fairly flat. Same with the compensation index. So people are still paying higher wages. And we saw that in the PPI. We see that in just the pricing in general, keeping things fairly well bid on the pricing on the cost side, which then feeds down to the price side, keeping that inflation elevated. And it's of no surprise that inflation remains the number one issue for small businesses. And taxes, again, not the same thing. But when you look at quality of labor and inflation are the top two concerns, and it's based on what we're seeing, that shouldn't be of any type of surprise, which is why the hiring plans are starting to come down. So still hard for small businesses to fill their jobs, but hiring plans are moving well off their peak. We're already seeing layoffs, as we talked about with the Challenger job cuts. We are seeing the hiring freezes. And again, that's what you're starting to see. So when you look at hiring plans, they're still normal, but we think that there's more downward pressure, which is going to bring some of those jobs hard to fill lower. Small business sales expectations firmly in recessionary territory as a net of expected higher sales fell to negative 28%. So there's a view that sales are going to fall. So again, you believe sales are going to fall. All of this leads to you're not going to hire, and you're likely going to try to protect and shrink. But small businesses continue to report pain from higher prices. As you can see, higher prices are still hitting hard, but poor sales still not a huge issue. So they expect sales to get worse, but this shows, just in terms of just what the data says, there's a certain amount of pass-through that can remain, that they can push through some of this pricing that continues to hit because the consumers are still willing to eat some of that. Now that is starting to diminish, which we'll talk about in the next segment. But again, that's still one of those drivers there. So then when you look at that sagging sentiment, negative 61% of small business owners said they expect better business conditions over the coming 6 months, down 7 points, worst in history. Expectations for better business conditions have reached a new low, and again, leading to some of those pressure in general. So that's what we have right now. In the next segment, we're going to go deeper into real wages, how is spending, and then realistically what is happening in real estate, because it continues to slump and get a bit worse based on some of the Redfin data out there.